Okay, hi my dear students, how are you? I hope everything is going well by your side, dears. Okay, today we're going, inshallah, in tutorial 7 to continue chapter 6, which titled Inventories and Cost of Sales. I have already started the chapter last time, tutorial 6, so we'll continue it now in tutorial 7. As I've told you, the main aim in the chapter is to know how to calculate the cost of goods sold and cost of ending inventory using different inventory costing methods. The 4 ones that we have already taken: FIFO, LIFO, specific identification, weighted average. Okay, we have taken last time how to calculate cost of goods sold under these 4 different inventory costing methods, but under the perpetual inventory system. Today we are going also to know how to calculate the cost of goods sold and cost of ending inventory, but using these 4 different inventory costing methods: FIFO, LIFO, specific identification, weighted average, but under the periodic inventory system. The technique or the way will differ. Okay, and we will see how in just a few minutes. Okay. Okay, we'll solve now problem 6.1a, the same problem that we solved last time, tutorial 6. However, now we will be under the periodic inventory system. Waterwoods Company uses a periodic inventory system. It entered into the following purchases and sales transactions. For March, for specific identification, 580 units are in ending inventory, with 20 units from March 1st, 60 units from March 5th purchase, 80 units from March 18th, and 80 units from March 25th as well. As I've told you previously, that for specific identification there should be some information provided in order to be able to calculate the cost of goods sold and cost of ending inventory and so on. What we will note now when solving on the specific identification, that it will not differ at all whether I'm under the perpetual or under the periodic system. Okay. Here is provided this table: column for the date, column for activities, whether purchase or sales, column for units acquired at cost, how many units were acquired and at how much cost per unit, and the last column, units sold at retail. And by retail I mean the selling price, as I previously told you. Okay, so these in this column provided are the units sold and at how much per unit, selling price per unit. This column will only be used if I want to calculate the sales. I just multiply the number of units sold times the selling price per unit. What's required from me here in the problem to compute the cost of goods sold and ending inventory under the following methods: the 4 inventory costing methods we have just taken last time, which are FIFO, LIFO, weighted average, first in, first out, last in. Okay, here when using the FIFO method, first in, first out, I'll have these 4 columns as we used to. The first column, the date, goods available, which are the beginning inventory plus the purchased ones, and column for the cost of goods sold, and finally column for the ending inventory. We have here on March 1st, the 100 units I started with, the beginning inventory at $50 per unit. The total number of units sold are 580 units. So I'll start by taking the 100 as sold units. So 0 units remaining on the first date, on the first day, 1st of March. Then 5th of March, I purchased 400 more units at $55 per unit. So I took also the 400 units sold at the $55 per unit, so automatically 0 units remaining on 5th of March. Then 18th of March, I purchased 20 units at $60 per unit, so I will take the 80 units in order to complete the 580 units sold. The 80 units only from 120 at $60 per unit. So 120 I took from them 80, so the remaining will be 40 units at the cost of $60 per unit on 18th of March. Then on 25th of March, I purchased another 200 units at the cost of $62 per unit. I didn't take anything for the cost of goods sold since I already completed the 580 units sold required from me. So the remaining or the ending inventory will be all the 200 units at the cost of $62 per unit. So here are the totals. We have the 80 units available for sale with their cost for $6,600. For the cost of goods sold, I sold 580 units. I will just add all these three numbers in the column of cost of goods sold to have the cost of goods sold totaled to $31,800. And for the ending inventory, I just add these last two columns, the 2,400 and the 12,400, to have for $14,800 of ending inventory. Is for the 240 units remaining in ending inventory. Okay, so as we have seen that if I'm under the periodic inventory system and I'm following or I'm using FIFO, I just move from up to down. I see how many units sold in total and I move from up to down if I'm under 5. As you have seen here, I took the first 100, then the second 400, then the second 80 to complete them 580 units sold from up to down. Okay. Going to LIFO, it is the opposite. I move from down to up. So it will be 580 units sold, so I will move from down to up as I said. So I take the 200, then I take the 120, now it's 320, so there are 260 remaining to complete the 580 units sold. So I will take the 260 from the 400 here, so the remaining units here will be 140. If we make 400 minus 260, it will be 140 units at a cost of 55, and the 100 is as it is remaining. Of course, here no units remaining on March 18th and no units remaining on March 25th. Then we arrive at the total. The same units, 812 units available for sale with cost 4600, and 580 units at cost 41600, and also 240 units remaining with a cost of 12,700. And as I told you before, at any point to make sure that we are on the right track, we just add the cost of goods sold with the cost of ending inventory to make sure that it's equal to the cost of goods available for sale, to make sure that we are on the right track. Then for the weighted average under the periodic, very simple. What I make here, that I calculate the average cost per unit. So I make the 4600 the cost of goods available for sale divided by the total number of units available, 820 units, which will give me $56.83 per unit. I just multiply this average cost per unit times the 580 units to arrive to the cost of goods sold, and times 240 units remaining to arrive to the cost of ending inventory. So the most important part we need to know here, that the average cost per unit is equal to cost of goods available for sale divided by units available for sale. This will give us the average cost per unit. Okay. Moving for the specific identification under the periodic, as I told you at the beginning, it is the same as the perpetual, no difference at all. No difference if the information was as it is. However, here the information is different although we will arrive at the end with the same numbers concerning the total, whether cost of goods sold, cost of ending inventory, and of course the total number is here. Let's see here, according to the information given to us for the specific identification, it's said that for the ending inventory we have 20 units remaining from March 1st, and 6 units remaining from March 5th, and 8 units remaining from March 18th, and 8 units remaining from March 25th, as you can see here. So we arrive to 240 units remaining with the cost of 14,060. So we add all the numbers at the last column here. And for the cost of goods available for sale, it is the same, that is 20 units of the 4600. Concerning the cost of goods sold, we are going to just see here 20 units remaining from the 100, so 8 units were sold, 6 units remaining from the 400, so 340 were sold, 8 units were remaining from the 120, so 40 were sold, 8 units remaining from the 200, so 120 were sold. And if we just make 4600 minus 14,060, it will give us 32,540. We'll just add all this column of the cost of goods sold, these four numbers, to arrive to 32,540, which is the cost of goods sold. Also, I will remind you again with our famous equation, cost of goods available for sale equals cost of goods sold plus ending Okay, moving to requirement number 2, compute the gross margin under the four methods. Comment as to which method gives the higher profit and why, as we have just done in the previous tutorial when solving under the perpetual system. So I just first calculate the sales. How can I calculate the sales? Just multiplying the number of sold units with the retail price, which is the selling price given to us in the last column in the table given in the problem. So I will multiply for 20 units by $85 the selling price, plus 160 units by $95 the selling price, which will give us $50,900. This is the sales. I just going to deduct the COGS that is already calculated in the previous slide under FIFO, using FIFO method, from the sales, which will give us gross profit 19,100. Then the same will be applied for LIFO in order to calculate the gross profit using LIFO, and the weighted average as well as the specific identification. I just take the cost of goods sold calculated in the previous slides under using each of the four methods, and I deduct it from the sales, which is consistent in all the methods. The sales is the same in all the methods. I deduct the COGS from the sales to arrive to the gross profit. Concerning which will give us the highest profit, as you can see here, FIFO gives us the highest profit since it gives us the lowest COGS, as I've just said previously. Since when we calculate the cost of goods sold using FIFO, we take the old cost, which is much less than the current cost, since we are always in an inflation period, which means prices are rising. So the cost of the recorded cost of inventory sold will be the old price, which is more or less than the current one. Unlike LIFO, for LIFO it gives us the lowest gross profit since it gives us the highest COGS, since the recorded cost for the goods sold will be the most expensive one, since it's last in first out. I sold from the last units that I've just purchased, so the cost will be the most expensive one, the highest one. So automatically it gives us the lowest gross profit. This is the command for this. Okay. Let's solve this exercise, some questions true and false on this chapter. Number 1, company must disclose any change in its inventory costing methods in its financial statements. True or false? Of course it's true. And the company should state in its financial statements if it changes the inventory costing methods from FIFO to LIFO, for example. It should be stated in the financial statements why if this change happened due to any reason. However, it should be stated in the financial statements. Okay, number 2, if the seller is responsible for paying freight charges, the transportation costs, then ownership of inventory passes when goods arrive at their destination. When the seller pays the transportation or freight charges, this means that the agreement is FOB destination or FOB shipping. It's FOB destination. So in the FOB destination, yes, the ownership of inventory passes when the goods arrive at the buyer's destination. So it's true. Okay. Number 3, whether purchase costs are rising or falling, FIFO always will yield the highest gross profit and net income. Of course, this is false, because let's see the first scenario when the purchase costs are rising. So if I'm following FIFO, or if I'm using FIFO, first in first out, this means that the goods that I purchased in the past with the low prices will be used to calculate the cost of goods sold. So this will yield the lowest COGS, which means, or which yield the highest gross profit, because they are inversely proportional to each other, and accordingly the highest net income. However, if the purchase costs, this is another scenario, if the purchase costs are falling or decreasing, and I'm following FIFO, first in first out, this means that the costs of goods I purchased in the past are of higher prices than now. So when calculating the cost of goods sold, I will use the costs used in the past, which are the high prices. So this will yield the highest COGS, cost of goods sold, yielding the lowest gross profit and automatically the lowest net income. So this means that when there are different scenarios that will happen if the purchase costs are rising or the purchase costs are falling. So the answer here will be false. Okay, number 4. In a period of rising purchase costs, LIFO usually gives a lower taxable income and therefore yields a tax advantage. If the prices are rising and I'm using LIFO, last in first out, this means that the last items I purchase will be sold first, which are with the high prices. So when calculating the cost of goods sold, I will use the highest costs, yielding highest COGS and automatically yielding the lowest net income and automatically the lowest taxable income, because as we said previously that the taxes are paid as percentage from the net income. So if I'm having the lowest net income, this will yield automatically the lowest taxable income and therefore yields a tax advantage. Of course, I will pay less taxes if I'm using LIFO to calculate the cost of goods sold. Number 5. FIFO is preferred when purchase costs are rising and managers have incentives to report higher income for reasons such as bonus plans, job security, and reputation. Okay, let's see when purchase costs are rising. This means that when calculating the cost of goods sold, I will use the costs that were the lowest, that were in the past. So this will yield those costs and automatically the highest net income. So yes, if the managers want to report a high income in order to have incentives, or they have incentives to report higher income for reasons such as bonus plans, job security, reputation whatsoever, so yes, FIFO will be preferred in this scenario. So it's true. Number 6, the choice of an inventory valuation method has little to no impact on gross profit and cost of sales. Of course not. The choice of the method will automatically have a great impact on the gross profit and cost of sales, as we have said in different scenarios. Because I use this method mainly to calculate the cost of goods sold, and the cost of goods sold and the gross profit are inversely proportional to each other. Okay. The last one here, number 7. A company has inventory with a selling price of $451,000, a market value of $223,000, and a cost of $241,000. According to the lower of cost of market, the inventory should be written down to $223,000. I have here the market value of $223,000 and the cost of $241,000, and I am applying the lower of cost of market. So which one will be lower? Of course, the market value, which is $223,000. So yeah, the inventory should be written down to $223,000. So it's true. Okay, now let's solve this MCQs on the inventory costing methods. Number 1, a company had the following purchases and sales during its first year of operations. On December 31st, there were 26 units remaining in ending inventory. Here we have this table available. For every month, how many units were purchased and at how much cost per unit. So I have here, if we add all these units purchased, I have 67 units available. Then I have the last column for the sales, how many units were sold. I will have a total of 41 sold units. So the remaining number of units were 26 units. So just deduct the 41 sold units from the 67 available units, it will give us 26 units remaining or ending inventory. Remaining in the ending inventory. Okay, using the periodic FIFO inventory valuation method, what is the cost of the ending inventory? Okay, so here it's determined that I'm under the periodic inventory system and I'm using FIFO inventory valuation method, FIFO inventory costing method. Okay, since I am using FIFO, first in, first out, if I'm calculating the cost of goods sold, I will move from up to down. However, here I need to calculate the ending inventory, so I will move from down to up. I see how many units were sold. There were 41 units. So for the ending inventory, as I said, I will move from down to up. So as you can see here in the calculations, I'll find that the 10 units in November are all available, are all remaining at $140. Then the 12 units are all remaining at $135 per unit. Then for the 15 units in May, I only have 4 units out of the 15 remaining at $130 per unit. Why only 4 units? Because if I want to see how many units were sold, there were 41 units. So the 41 units, since I'm using FIFO, so I will take them as 10 units at $120, then 20 units at the $125. So the remaining 11 units that I'm going to take them from May at $130 per unit. from the 11 units, I'm going to take them from the 15 units in May. So the remaining will be in 4 units, only 4 units in May, remaining or ending inventory. So 4 units at $130, as we can see here in the calculations down, and 12 units at $135, as well as the 10 units at $140 per unit. I'm going to add them all these costs. It will give us $3,540. So this is the cost of the ending inventory. Okay, let's see the second one in the MCQs here. A company had the following purchases during its first year of operations. We have this table for every month, how many units were purchased and at how much cost per unit. In January, I have 10 units at $120 per unit. In February, 20 units at $130 per unit. In May, 15 units at $140 per unit. In September, 12 units at $150 per unit. And finally, in November, 10 units at $160 per unit. On December 31st, there were 26 units remaining in ending inventory. These 26 units consisted of 2 from January, 4 from February, 6 from May, 4 from September, and 10 from November. Using the specific identification method and periodic inventory system, what is the cost of the ending inventory? While we are using the specific identification method and we are under the periodic inventory system, as I said before for you, that the calculation of the COGS or ending inventory using specific identification is the same whether I am under the perpetual or the periodic inventory system. Also, as we said before, that for specific identification method, I should have some info or some data related to either the cost of ending inventory or the cost of goods sold in order to be able to calculate this cost. So here I have information regarding the cost of ending inventory, and it's required from me to calculate this cost. I just want to remind you with a very important thing here. If it was required from me to calculate the cost of goods sold and the given info is for the cost of ending inventory, no problem. I will just calculate the cost of ending inventory. Then I have the cost of ending inventory as well as the cost of goods available for sale. How do I get the cost of goods available for sale? I just multiply all the units I have here in the table, which are the 10, 20, 15, 12, 10. I multiply all of these units times their per unit cost in order to arrive to the cost of goods available for sale. So I have the cost of goods available for sale and have the cost of ending inventory calculated based on the info I have for the ending inventory. So I just deduct the cost of ending inventory from the cost of goods available for sale that I already calculated in order to arrive to the cost of goods sold. So it's easy, no problem. If I have info regarding the cost of ending inventory and it's required from me to calculate the cost of goods sold, I just get the cost of ending inventory and the cost of goods available for sale. And we know the important equation that the cost of goods available for sale equal the cost of goods sold plus ending inventory. So I just substitute in the equation in order to arrive to the cost of goods sold. However, here it's easy. I have the info regarding the ending inventory and it's required from me to calculate the cost of ending inventory based on the info I have. So, as you can see here in the calculations, I will just multiply the 2 units from January 4 by the cost per unit in January, which is $120. Then I'm going to multiply the 4 units remaining in February by the cost per unit in February, which is $130. Then I multiply the 6 units remaining in May by the cost per unit in May, which is $140. Then in September, I have 4 units remaining. I'm going to multiply them with the $150, the cost per unit in September. And then in November, I have 10 units remaining. I'm going to multiply them with the $160 cost per unit in November. Then I'm going to add all of these costs to give us $3,800. So the answer will be 3,800. This is the cost of ending inventory using specific identification under the periodic inventory system. For number 3, Referring to number 2 using the specific identification method also, but here under the perpetual inventory system, what is the, do you think it will differ? No, it will not differ, because as I have just said to you from a few minutes, that the cost of ending inventory or the cost of goods sold using the specific identification, whether under the periodic or perpetual inventory system, so the answer will be 3,800 also, the same as the previous one. Okay. Okay, moving to another topic, another concept, lower of cost or market. This approach is a conservative approach. State that I should select for the inventory the lower of the cost, the historical cost that the inventory was purchased by, or the market. I select the lower of both of these for recording the inventory. Why I call it a conservative approach? Because this concept helps us to abide by very important principle in accounting, the GAAP, the generally accepted accounting principles, which is the conservatism or prudence, since it helps us to account for the loss before it actually happens, or in case it happens. Because the value of the inventory or the price of the inventory fluctuates, so the price maybe fall below the net realizable value. That's why we tend to account for the loss in case it happens. Therefore, we select the lower of the cost of the market to record the inventory. So let's see this exercise. A company reported the following data related to its ending inventory, and here is the table given, consisting of 4 columns. The first column for the product, the second column units available for each product, the third column for the cost, and the fourth one is for the market. What's required here is to calculate the lower of cost or market on the inventory applied separately to each product. I'm going to add which is total cost. As you can see here, I highlighted it, and also total market, I also highlighted it, and the final column is LCM by product. Okay, let's see for the first product, which is 849. I have the cost 1,000. When I just multiply the $10 cost per unit times the 100 units on hand, gives us 1,000. And for the total market, I just multiply the $11 with the 100 units, gives us 1,100. So for the LCM by product, the lower of cost or market, I'm going to select the lower of these two, which is the 1,000. Moving to the following product, which is 842. I'm going also to multiply the units on hand, which are 75 units, times the cost per unit, which is 16, which gives us 1,200. And to get or to calculate the total market, I just multiply the $14 market times the 75 units on hand, which gives us 1,050. So we have the total cost 1,200, the total market 1,050. So to apply the LCM by product, I'm going to select the lower of both of these two numbers, which is the 1,050, the market. Then for product number 147, I multiply the 60 units on hand times the $14 per unit cost, which gives us 840. And then I multiply the 60 units on hand times the $13, gives us 780. Then to apply the LCM by product, I select the lower of these two numbers, the 840 and 780, which will be 780, as we can see in the final column, LCM by product. Finally, for the product 860, I also multiply the 40 units on hand times $16 per unit cost, which will give us 640, and I'm going to multiply the 20 market price times the 40 units on hand, which will give 800. Which of them is lower? 640 or 800? Of course 640. So in the final column LCM by product, I'm going to write 640. Then I just add the last three columns, the total cost, total market, and LCM by product. And that's it. So again, the lower of cost or market is a conservative approach, since it helps us to account for the loss in case it happens. Because as I said, that the price of the inventory may fall below the net realizable value. So I account for the loss before it happens by selecting the lower of the cost or market, which we call it LCM. Okay. Okay, let's see another exercise for the lower of cost or market. A physical inventory of Liverpool company taken on December 31st reveals the following. Here is the table. The first column is for the items, the different items. Second column for the units, then the cost per unit, and finally the market per unit. What's required here? First, to compute the lower of cost or market for the inventory applied separately to each item. Then, if the market amount is less than the recorded cost of the inventory, then record the LCM adjustment to the merchandise inventory account. Let's start with the first requirement, which is compute the lower of cost or market for the inventory applied separately to each item. So what I need to do here is that for each item, I see how many units for each item given for me in this table, and I just multiply this number of units with the cost per unit to arrive to the total cost, which is here the first, second, third, fourth, which is here the fifth column. The total cost is the fifth column. And I also multiply the number of units with the market price per unit for each item in order to arrive to the total market, which is the sixth column here. Then I'm going to compare the fifth with the sixth column, the total cost column with the total market column, and see for each item which number is the lower. And I select the lower one from the cost or the market, either the cost or the market. For example, for the speakers here, the total cost is 31,050 and the total market is 33,810. So when I'm going to apply the LCM applied to items, I'm going to select the lower one, which is the total cost, 31,050, as you can see here in the last column. For the stereos, the total cost is 28,860. When I multiply the 260 units times the cost, 111, gives us 228,860. And for the total market, when I multiply the 260 units with the 100 market price per unit, it gives us the total market 26,000. I'm going to compare these two numbers to each other, 28,860 and 26,000, which is lower. Of course, 26,000 is the lower, so I'm going to write it here in the last column, LCM applied to items, and so on for each item here. Then at the end, I'm just going to calculate the total. For example, this column, the total cost, I add all these numbers in this column, gives us 292,777. And for the column of the total market, I just add all this column, all these numbers in the column, gives us 285, 242. And for the last column, LCM applied to items, that's what's required from us in requirement number 1. I just add all these numbers in the last column, gives us 273,054, and this is my answer for number 1. So compute the lower of cost or market for the inventory applied separately to each item. It is 273,054, as we have just added all the numbers in the last column, LCM applied to items. Number 2, if the market amount is less than the recorded cost of the inventory, then let's see the market amount. The market amount is 285,242, and the recorded cost of inventory, and the cost of the inventory is 292,777. Then we record the LCM adjustment to the merchandise inventory. So we find that the market is less than the recorded cost of inventory. That's why we need to make an entry for the LCM adjustment. What I'm going to make, the entry is going to be debit COGS and credit merchandise inventory. I'm going to increase the cost recorded, the cost of goods sold, with how much? With the difference between the 292,777, the cost here, and the difference between this number and the 273,054 for the LCM applied to items. The difference between these two numbers is the number that I'm going to insert here in the entry, 19,723. Again, for the entry for the LCM adjustment, I just debit the COGS, I increase the cost of goods sold. This happens when the market amount is less than the cost. As we can see here, the market amount is 285 and the cost is 292. So when it's less than, the market amount is less than the cost, I need to make an entry for the LCM adjustment. By how much? The difference between the LCM applied to items here and the cost, the total cost. So it will be 292,777 minus 273,054, which gives us 19,723. Okay. Again, I will explain briefly for you the idea for the LCM, the lower of cost or market. I just see the items, how many units for the items I have, and I multiply it by the cost per unit in order to arrive to the total cost. And then I multiply it by this units, I multiply by the market price per unit to arrive to the total market. And I just compare the total cost with the total market, and I will select the lower of these two numbers in order to arrive to the LCM applied to items, which is the last column here for us. And then I add this column in order to arrive to the lower of cost or market for the inventory applied separately to each item. Okay. For the second requirement, if the market amount is less than the cost of the inventory, as we can see here, the market amount 285,142 and the cost 292,777, so I need to make an entry for adjusting the LCM to the merchandise inventory account. So I debit the cost of goods sold and I credit the merchandise inventory with how much? The difference between the cost of the inventory, total cost of the inventory, which is 292,777, and the LCM applied to items, which is 273,054, which gives us 19,723. And that's it for our tutorial 7. Hope it was beneficial for you. Thank you.